thank you very much indeed for inviting me to do this talk, and I'm really sorry not to be part of the actual conference, but I hope the Q&A will go well. I'm going to talk about housing, the ageing demographic, international developments, mostly about England, sometimes about Europe. The first, I want to do it in three sections. The first on affordability, the second on mortgage products for the elderly, and thirdly on the bank of mum and dad, which is how the elderly get rid of their money. And so starting with affordability, I know that for many elder people in Australia, affordability is a major crisis, particularly in the private rented sector. But I think in Britain we'd have to say that for the elderly, we are living halcyon days. About 75% of those of retirement age own their own home outright. They do not have to pay anything other than their costs of maintaining it. Secondly, government people and private pensioners who have got defined benefit systems are extremely good position. They know exactly how much they're going to get, and it is index linked. Thirdly, housing doesn't have any capital gains tax. It has some inheritance tax benefits, and Social Security enables people to keep their own home rather than have to lose it when they run out of money. So the owner-occupied sector, which is nearly 80% of the total, as some of them have still got mortgages, is fundamentally a very happy group, especially as Social Security has gone on even through austerity, being just as generous. So then there is the rental sector, and that's a case of decline in the social rented sector from about 25% by 9% to 16%. But that group of people have got security of tenure. They've also got help with their rents up to and including the point where they pay nothing for their rent. So the people who are really at risk are a very small number of people who've mortgaged their homes very late, but much more the private rented sector. But the private rented sector only accounts for 6% of households who are over 65. So, and they also get housing benefit, although it's not as generous as in the social rented sector. So at the moment, the elderly are better off than they have ever been. Indeed, the post-85-year-olds aren't as well off as the rest of that group, but overall, they are fantastically well off because they were here for the rapid growth in house prices. They've got wealth, they've got income, and they've got security. But this isn't going to last. The numbers over 65 are going to rise by about 150,000 a year, which accounts for something like 3/4 of the increase in households that we're expecting to see. Owner occupation has been declining since the early part of the century, so people are going to start to come forward many more who are in the private rented sector, though it will take some time before that happens in large numbers. But more importantly, owner-occupiers have been able to take out interest-only mortgages and to extend their mortgage life, so that many people are beginning not to have paid off their mortgage at the time when they retire. I remember 15 years ago being in New Zealand and the young people talking about how they would just recycle their mortgages and take them out and go off around the world. Well, the elderly do it as well. And we have large numbers of people who are not going to be debt-free after they retire. And of course, there's a much more general issue of intergenerational equity. These old people have got all this wealth, which is not being taxed or hardly taxed at all, while young people are finding it extraordinarily difficult to get into the housing market at all. And in private pension terms, of course, we've gone from probably 60%, 70% defined benefits to, if you're lucky, defined contributions, and if you're unlucky, no pension at all other than the state pension. Well, the people in social housing are continuing to decline. There is discussion about expanding the size, but at the present time it is certainly still in decline. And private rented sector is growing. It now is 25% of all Londoners and 20% across the country. And while this doesn't include many elderly people yet, those who are 45 and 55 who have not bought will be coming into that section fairly soon. So in affordability terms in Britain, I would say we are really as well off as we have ever been, but we can see why that will break down over the next 20 to 30 years. So in that context, how do we go in relationship to the rest of Europe? Well, the European social security system is a very much stronger system than ours, and not so dependent upon helping housing costs rather than helping income in general. So in the main, one would argue that although renting is much more the norm, that renting is usually of better quality than we have, and in some cases the rents are controlled, but more generally the rents are stabilised, so that if you are an elder person who isn't going to move, you know exactly what your rent is going to do. It's going to go up in relationship to inflation or something of that sort. So Europe is generally relatively well prepared. That doesn't mean that there aren't a lot of people who suffer on the margins, but to be perfectly honest, most of those are younger. So I think that's a very different picture from the Australian one. So moving to the question of these mortgages which people have now got, it's rational to grow a mortgage market for elderly households. In many ways, their incomes may be as secure as anybody in work and reasonably large, and they've got large equity in their homes. So borrowing against that home in one way or another makes a great deal of sense. What we saw in the past was you were expected to have paid off your mortgage at retirement because you wouldn't have the capacity to do so later. But you have got that capacity, and moreover, because so many fewer people are going into owner occupation, the mortgage market needs new products. So they are extending the interest-only mortgage into 70-year-olds, 80-year-olds, and in some cases 90-year-olds, so that people don't indeed have to think about how they would actually pay off the principal. And this makes a lot of sense because of the security of the income, because of the large numbers of households. Many anyway need to realise some equity to maintain their standards of living or to extend their standards of living, and also, as we'll come to later, to help young people. And others may wish to borrow against one property in order to buy another. And one of the things I haven't talked about is how many older people now own a second property. And while it's not an enormous proportion, it's significantly higher than it was. So looking at the reason for mortgages is just that it's an extension of their lifestyle. And in a sense, they took out an interest-only mortgage when they were 50. Why should they expect to have to stop that at 65? And now they don't. And new products do have to be brought in, but they can die in debt without it causing any real problem. And in policy terms, the Treasury is arguing very strongly that what they would like to see is us build up our wealth during our working age and then to run it down for our needs so that the government is not facing having to look after adult or elderly social care, which they feel they cannot afford to, and why indeed should they when so many people can afford to pay it themselves. In the UK, if you turn on your computer and you're foolish enough to be in a position that you get advertisements on it, the most usual advertisement in my case, I very rarely get it, I'm glad to say, is an equity release product.
Right, said Fred, we want to help the family. Let's chat about releasing equity. The boy needs his own house.
Got himself a new spouse. The LV kid is on the way soon. And so we had a cup of tea.
Alan gets to explain to homeowners over 55 how they can release tax-free money from their home, how they would not have to repay the money until they passed away or moved into long-term care.
That is to say that you take out a lump sum and you pay interest on that in the normal way, but it is all bound together. Now, this issue of equity release is that although you do get a lump sum, the costs of that lump sum are very, very difficult to determine. And the loan is repaid with interest. So if you happen to live forever or very long while, you will in fact run out of equity, however rapidly that equity is going up. So what has happened is that the providers of this product have put in a guarantee that you will never go into negative equity. But that is a guarantee which they have no idea how much it can cost them. My next door neighbour, who is 102, took one of these out in her early 80s, and the insurance company is paying her a fortune with nothing really to back it up. So there has been a lot of mis-selling of that product and a lot of concern about the product. And the research project which we're doing at the present time, which is on the popularity of mortgages of different types for elderly, says equity release is really hated by most people, not necessarily for very good reasons, but it's also hated by the regulator because they are not at all clear that the risks to the providers are fully understood. So what has happened is that remortgaging has become the order of the day, and an interest-only mortgage, which you've been paying up till now, you can continue to pay as long as the interest rate doesn't go up very significantly. And these are becoming increasingly available. I think that we'd have to say that I don't know what the situation is about equity release products in other countries, but they are very clearly difficult to regulate. And in a world where we do not really know what proportion of people are going to live to 100, it's pretty dangerous to finance them. And Professor Dowd says, we've known how to do these valuations properly since the seminal options pricing paper of Black, Scholes and Merton in the 1970s, but the regulations around these mortgages are not properly drawn up. So I think that I would say on terms of mortgage products that they're an entirely sane and sensible extension of normality. But when it comes to equity release, there are really significant concerns about the risks that both lender and borrower are bearing. And then we come to the most immediate issue for many, many people in their 40s, 50s and 60s, is that their children can't get into the housing market or can't afford to get the sort of home that they want to. So we're looking at a massive growth in the Bank of Mum and Dad, that's what it's called in the UK, which is now either the 9th largest bank in the country or possibly even the 6th largest bank in the country. And the evidence suggests that a third of first-time buyers get help from their family or from their friends in order to pay the down payment or in order to pay their regular monthly costs. The third is a bit uneven. Some evidence suggests about 29-30%. Other evidence suggests that it's a bit higher than that. The average amounts that people get are around the 25,000 mark. So if you've got 3 kids and you wish to treat them evenly, you've got to find 75,000. So of course you may end up borrowing yourself in order to allow your children to borrow. On the whole, over 50% of the money goes to help with deposits. And deposits, of course, have become very much bigger since the financial crisis. It may just be to pay the sorts of costs which a mortgage can't cover, which is the stamp duty and legal fees, these sorts of things. It may help with the monthly payments, or it may be just about guaranteeing a mortgage rather than giving out money. We're doing a study at the present time in which we asked what was their feelings about helping their children. And they said they were pleased to be able to help, nearly everybody was, but they felt that it was unfair that young people should require help. They didn't get help. And they are particularly concerned about what happens if their circumstances change. Most importantly, divorce or breakup, where it's unclear who will actually end up with the money. And a few people, but a relatively few people, are concerned about their own longer-term finances. And what we were really concerned about was the relatively few people who take any financial or legal advice, and yet there are tax implications, there are implications for the parents in terms of social security, there are all sorts of difficulties when blended families break up in one way or another, and yet less than 10% of people take advice on legal issues, and only slightly over 10% take it on financial issues. So helping children can be at a cost of saving for your own care, and some respondents do worry about poverty and old age coming out of it. But I think the thing which we found most important was that the Bank of Mum and Dad does not behave like a bank. It does not do any of the things which it ought to do. It doesn't take advice. There's usually no written record of transactions. There are numbers of times when Dad has thought it was coming back in 3 years and the child has thought it was a gift is enormous. Arrangements for repayment are therefore very, very unclear. And the what-ifs in terms of health, in terms of divorce, etc., have not been really thought out. So will it go on expanding? 50 plus is almost certainly going to be able to afford to help their children, but future generations are going to be in the situation of having a big mortgage and no secure pension in the same way, are going to find it more difficult. The policymakers really do like it because it helps to move the system without them paying anything. But of course it also privileges the well-off. It's very, very difficult for the child of a tenant to get into housing of this sort, and the danger is of widening inequality. And to be fair, regulatory arrangements are having to catch up. So there is a need for these mortgage products. To some extent, because of the rapid inflation in the past, they're very secure at this stage. The supply side needs to grow the market. So it's not surprising that they're really becoming important. But I think it's important also to look at other countries where they've been around for longer and where these issues are strong. And those are Denmark and Sweden. Countries, Sweden never pays anything back, or they've tried not to. We're now required to make some payment of principal. And Denmark, the elderly have always been more indebted, or at least in the times that I've been looking at it for 30 years, the over 50s are more indebted than the young. I think that I would love to talk about private renting, but I'd better stop here. Thank you.